makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The Bank of Japan ends the most aggressive monetary stimulus program in modern history by hiking rates for the first time in 17 years. Nvidia unveils new chips aimed at extending the company's dominance of AI computing, a position that's already made it the world's third most valuable business. And on the first-year anniversary of UBS's historic takeover of Credit Suisse, we also look at how the company has pushed its market cap past $100 billion to the highest level in almost 16 years. Now, later this hour, also our exclusive conversation with the chief executive of Honeywell, Vimal Kapur, on how the company is preparing for the future of automation, aviation, and energy. But first thing is first, it is a momentous day when it comes to central banks, and of course, the move that we saw in JGBs and yen. And now, for the moment, U.S. futures, a lot of the focus is now on the Fed. U.S. futures pretty much unchanged. A lot of what was priced in, for example, from Nvidia, that's playing out in the markets, not so much. Nvidia pretty much flat pre-market. And then, of course, the big one is the Bank of Japan. So after 17 years, and I'm actually quite surprised that the market's very cool about this because the BOJ did a great job in telegraphing it so that everyone was nice and prepared for it. But this is the first hike in 17 years by the BOJ. It's been widely expected. The governor, of course, had telegraphed this. And he also struck a neutral note at the news conference, saying there's still a chance that its inflation goal will not be hit. The central bank, once again, scrapping its yield curve control program, but it's also pledged to keep buying some of the long-term government bonds, and they are in the market. So overall, you can see yen, and we'll also get to JGBs a little bit later, but yen 150.35. The U.S. 10-year, again, waiting for the Fed at 4.3183. Now, for more on all of this, the markets, BOJ, and of course what we're expecting from the Fed, we're joined by Madison Faller, global investment strategy at JPMorgan Private Bank, and also Bloomberg's Paul Jackson. So, Paul, Madison, thank you both for joining us. Madison, this is exciting. 17 years they got rid of it, and it hasn't been the end of the world. I mean, does it just goes to show that if the central bank telegraphs it clearly to the markets, you can almost pretty much get yourself out of any situation.
Yes, I think this has been a really incredible meeting to watch unfold. And I think from my perspective, it's one that feels very emblematic because it does feel like we are now in a new era, and maybe this time is different for Japan, and also when it comes to investing in the economy's markets as well. But I do think, to your point, the meeting in and of just by itself isn't quite a game changer in the sense that, one, it was very well telegraphed, which I think is flowing through into some of the market moves that we're seeing. And also, even though we've seen that rate hike, we are seeing a lot of accommodative leanings within some of the other details.
So let's also go to Paul Jackson, who's in Tokyo for us. Paul, when you hear what the BOJ had to say, so first of all, of course, it scrapped its yield curve control, but it's pledged to keep buying this long-term government debt. I mean, for how much longer and how much?
Hey, look, I don't think the Bank of Japan's ever going to stop buying government bonds, to be honest. I think they've got there's too much at stake in terms of the Japanese government and its huge debt. They've got to always keep an eye on those bond yields. But look, we've heard Governor Ueda repeat this throughout his press conference. This is the end of easing of another dimension, the unprecedented easing campaign that Governor Kuroda, the previous governor, brought in 2013. So we are at a shift here. We are at a movement, a turning point. Has the move today been huge in itself? Well, no, it's not been that big. But there's a lot of talk there that, hey, this is one and done, and he's not going to be raising interest rates again this year. I would say, hey, be cautious on that one. We've heard Governor Ueda give a lot of dovish comments in the past, but look at what he actually does. He's achieved a lot more in this 11 months than anyone expected, and I would certainly caution against the view that he's done for this year.
Yeah, Madison, what's your take? Again, we had very few clues on further hikes. So is the market mispricing it?
I think it's a fair question, and I think I would be reticent to say that it's just one and done when it comes to the rate hike that we just saw. I think it's possible we could see further moves later this year, but I do think that the BOJ will remain very cautious in terms of its approach, which of course they've well telegraphed. But ultimately, I think that really comes down to the idea that saying that 2% inflation will be achieved is different than saying it already has been achieved. And I think that while the wage data that we've seen has been really promising, we haven't yet seen that really flow through into higher consumer spending. So we really need to watch that domestic demand and that business investment and CapEx data, I think, to really give us a clear sense for how successful Japan has really been in reinflating its economy.
Yeah, and this is really the crucial bit, Paul. How difficult after the wage, we've had the wage negotiations, we're now out of negative rates. How difficult will it be to reach 2% and stay there?
Hey, well, if you're asking me, I can tell you that I think this point of the positive, virtuous cycle of prices and wages feeding into consumption, that these comments are right. This is not yet proven. We're not yet sure that this cycle is strong. It's not feeding into consumption yet. We've seen that in the GDP figures, 3/4 of consumption in real terms actually falling. There's a lot of proof that still needs to be produced that we are at this virtuous cycle. However, I think that Governor Ueda has a much more conventional policy mindset than his predecessor Kuroda, and that's the point people need to have at the back of their minds when they're thinking about how much space he wants to create with his policy tool.
But, Paul, is a bigger upward price risk something that's a possibility this year, or is that a story for 2025?
Hey, well, look, I mean, this is a tricky part. We've got a lot of complications in these figures. There's all these government subsidies for energy. And, hey, if the government pulls away these subsidies, then you're going to have, price impacts there. Already we're expecting quite a bump in inflation in February on a subsidy distortion that's going to take it probably to about 2.8%. Hey, with those kind of numbers in April, there is a risk that that upward trend in inflation is going to look stronger than it does right now. And, hey, Ueda was asked this specific question in the press conference, if your forecasts or the risks looked stronger in April, would you have to raise rates? And he said, hey, look, if the risks on prices are outperforming what we expect, we'd have to raise rates.
Madison, what does this mean for the Fed? Again, the dynamic between, of course, Japanese and U.S. rates is set to continue.
I think that's right. I think, U.S. rates are still in the driver's seat from that perspective. That yield differential remains still quite wide, even with this rate hike. And I think when you take that in tandem with what we're seeing from the Fed, we're looking at the idea that rate cuts now feel less urgent than they perhaps did at the start of the year, just given this resiliency that we've seen in the economic growth data, some of the stickiness that we've seen in inflation. And so we think that, roughly 75 basis points worth of cuts are reasonable for the course of 2024. And we'll surely be watching that median dot for 2024 as we head into this meeting later in the week.
So when you look at equities versus treasuries versus currencies, where do you see the most value right now?
Within the U.S. or globally?
Globally.
Globally, I think, the balance of risk from my perspective, especially when you're in a, softer landing, more pro-growth environment, is still within equities. And I think, again, you have to think about the fact that the Fed is cutting not because you're in a more protracted downturn, but because growth is good and inflation is decelerating. And at the same time, earnings have continued to surprise to the upside. So that leaves me constructive from that perspective. But I really think that first and foremost, that first move needs to come from stepping out of cash. A lot of investors are still sitting on the sidelines with yields still quite high. You probably don't have to run out of cash, but perhaps you should still jog. And, there are also opportunities across the fixed income curve. But I think, in a pro-risk environment, I would still favor stocks.
Okay, Madison, thank you so much. Madison Faller, the global investment strategist at JPMorgan Private Bank, and Bloomberg's Paul Jackson in Tokyo. Coming up, Nvidia unveils the successor to its all-conquering AI processor. We'll have the details next. Plus, take a quick look at the Unilever share price. Now, the company plans to separate its ice cream business. That includes brands such as Ben & Jerry's. As the chief executive, Heinz Schumacher streamlines the firm by cutting 7,500 jobs. So Unilever is actually on the way up. We'll have plenty more on Unilever shortly. This is Bloomberg.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
Well, Nvidia chief executive Jensen Huang there speaking at the company's annual AI conference. Now, the company unveiled this new processor design called Blackwell, aimed at extending its dominance of AI computing. Still with us, Madison Faller from JPMorgan Private Bank, and also with us, Bloomberg's Alex Webb, who covers tech for us. Alex, thank you for joining us. Madison, thank you so much for sticking around. When you look at Nvidia, I mean, he seems to be like a kingmaker. I mean, it's like the Oprah of the AI world. But he disappointed a touch. Is that because there were concerns that he can't keep up with the growth so far, or is it just that analysts expect too much of him?
It's actually a pattern we see quite a lot with Apple. The kind of adage is, buy the rumor, sell the news. There weren't any great surprises in the course of the conference in terms of the technology that was presented. It was impressive. A lot of the notes, analyst notes reflecting on that said as much. But even with Apple, when they unveiled the Vision Pro, the stock actually lost something like $80 billion worth of value, of course, for a $2.5, $3 trillion company. That's just a blip, really. But it still often loses value when products are unveiled, simply because people know what's coming and maybe there's a little bit of profit taking.
So what was your main takeaway from yesterday, Alex?
I mean, there are two things, basically. This new chipset is obviously, setting a new standard, and it's going to be harder for would-be competitors to catch up, as they are trying to catch up with what Nvidia was already selling last year. Nvidia's moving on to the next thing. That does then, of course, give them a great deal of pricing power. One of the reasons that we saw such a surge in revenue last year was not just that they were selling more chips, but they were also able to charge really premium prices for those chips. And as more supply comes online, there was some concern that maybe that would reduce some of the pricing power. By continuing to innovate and introducing this new lineup, which, is considerably faster when it comes to the AI processes than the prior generation, they're able to maintain that high pricing, most probably, which will then, of course, help support the pretty punchy valuation that we've seen.
Madison, what does this mean for your portfolio building? Again, if you look at the Magnificent Seven, is that something that you want to be invested in, or do you actually look at it more holistically, like AI will transform all industries?
I think it's both. I think we continue to be constructive on tech broadly. I think there's a lot of dispersion within that, so you do need to be selective. For instance, not all Magnificent Seven names are created equal. So you can see that in some of the price performance, especially over the course of the last few weeks. And when you think about the earnings growth potential within the Magnificent Seven, both in the year ahead, but also what we already saw last year, I think it's certainly something we want to make sure we have exposure to in portfolios. But at the same time, to your point, we are seeing broad industry adoption. And so I think what we're really watching there is, how does that translate into the productivity data? How does it translate into operating leverage for firms across sectors? And I think we do anticipate that, investment in AI should contribute to real revenue growth, probably sooner than most people expect.
Is the 60-40 portfolio still alive?
I very much think so. I think I also have to say that from a multi-asset class investments perspective. But no, I think, when you think about some of the changes we've seen over the course of the last decade, you've seen, I think, bonds are very much, back. We've had a little bit of a struggle over the course of the past few years as we've had, interest rate volatility. But I think with, income rates as high as they are now, you can now arguably achieve the same return that you would have perhaps, 5 5, 10 years ago with less risk today. And so I think from that perspective, you are looking at, I think, the benefits of having a 60-40 portfolio. But with that said, I do think, it would be prudent to bolster that with alternatives. So when you are in a, stickier inflation environment, you could look at infrastructure and real assets to provide some of that protection. And of course, private markets offer, I think, the opportunity to capitalize on some of those more niche opportunities that perhaps you can't always unlock within public markets.
Madison, on Thursday, we also have the Bank of England.
Yes.
And there's not much expected in terms of policy change. But do you start worrying about, I guess, the weakening of the labor market?
I think it's a fair point. I think out of all the developed world, central banks, I think when you think about the BOE, the Fed, and the ECB, we think that the BOE is probably the last to cut. That's probably going to happen towards the back half, towards the end of this year, in our view. Of course, the risk of holding on, to higher rates for too long. Creates the potential for weakening the labor market. But at the same time, you are still looking at, inflation that's still quite high, even though it is past its peak. And so I think we're just really hitting at that tension and that balance that all central banks are really grappling with at the moment.
Wonderful. Thank you both for joining us. Madison Faller there from JPMorgan Private Bank and Bloomberg's Alex Webb. Now, coming up, we'll be discussing the rivalry between the U.S. and China with Robin Niblett, the former director of Chatham House, but also newly minted author of the new book, The New Cold War. That's next, and this is Bloomberg. Well, tensions between China and the United States shows no signs of letting up as the two sides spar over areas like defense and technology and their response to two wars on the global stage. Well, Robin Niblett is the former director of the Chatham House and author of The New Cold War. His book looks at the contest between two global superpowers and how Europe is stuck in the middle. Well, Robin Niblett joins us now. Robin, first of all, it's a good-looking book. I mean, was that the hardest part, actually, trying to get a cover for this book?
Working so hard, Atlantic Books delivered me the cover, said, "What do you think?" And I said, "That looks great. Let's go with it." So. That's
disappointing. I thought you were going to choose. I mean, this kind of really goes back to Cold War era,
yeah,
right?
Absolutely.
1980s. And you're trying to draw parallels, whilst at the same time saying, everyone, look, China's not the USSR and the US is not like it used to be.
Yeah. I mean, I think the core element when you think about here, we think this is a geopolitical competition alone. Rising power takes on the established power, the famous Graham Allison, the Thucydides trap. But one of the things I point out in the book is that there's a really important underlying theme, which is the ideological contest between the two sides. China in particular, I think, believes that checks and balances, what we are used to in democratic societies, are bad for government, that ultimately you can't make as good a choice. The United States, along with its allies, obviously supports checks and balances, democratic government. Might be messy, but at least you get long-term sustainable answers. And each side have realized that the other is a threat to its system. So I think China probably realized this earlier. They started backing away. I talk about reversing into a Cold War, one of the big differences from the last one. They started backing away from the US technologically, in particular, a long time ago, even from trade. So I think, the US are catching up with the realization.
So, I mean, there's two things that stood out for me. Is first of all, you understand China quite intimately because of all your years at Chatham House. And I've always been told, look, you speak to the Chinese differently than other superpowers. Are we on the brink? I mean, we have a U.S. election. If the West pushes back against China so long, what will they do?
Well, I think the simple matter is any contest, and we're seeing this, by the way, in Russia, Ukraine as well, each side needs to know where the other stands. One of the dangers in the last Cold War was misinterpretation, not understanding the purpose of the other side. So, example, around Taiwan. Now, this is a classic area where China's trying to put down red lines, but so has been the Biden administration. Clarity becomes absolutely essential. Open lines of communication become essential. The problem is we're in the early stages of this Cold War. It's like a pre-Cuban Missile Crisis version of that. The two sides don't know where their red lines really stand. I think the South China Sea right now, in some ways, worries me more. than the Taiwan crisis.
I mean, I know that President Xi, and you explained this beautifully again in the book, has certain targets for 2049 to be the world superpower. Will he achieve that, given what we've lived through in the last 2 years?
Well, I think what he talks about is achieving national rejuvenation, being a moderately prosperous country. It's that lovely Chinese way of describing very ambitious goals. By 2049, however, the Communist Party needs to be legitimized in its continuing rulership of China, and that means Taiwan being inside the fold by that time. A lot of people are talking about 2027 as maybe a near term, but I think what China's trying to do in particular is make sure it's stabilized itself and that it is not dependent upon enemies. So you've seen China pulling back its technological linkages with the United States, and vice versa, obviously. I think China under Xi Jinping is willing to suffer economically for a period in order to be more secure in the long term economically.
Robin, thank you so much. Robin Niblett stays with us. We'll talk more about his new book, and of course we'll talk about where the new geopolitical reality leaves the UK and the EU. That's coming up shortly, and this is Bloomberg. Well, the Bank of Japan ends the most aggressive monetary stimulus program in modern history by hiking rates for the first time in 17 years. Nvidia unveils new chips aimed at extending the company's dominance of AI computing, a position that's already made it the world's third most valuable business. And on the first-year anniversary of UBS's historic takeover of Credit Suisse, we look at how the company has pushed its market cap past $100 billion to the highest level in almost 16 years. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Well, Robin Niblett is still with us for more on his book, The New Cold War, How the Contest Between the U.S. and China Will Shape Our Century. Let's discuss what the new reality also means for Western powers and the future of the UK. Robin, first of all, congratulations on a short, well-thought book that tries to explain the very complicated world we live in. Where does the EU sit on this? So between this big rivalry, the U.S. and China, the EU, I guess, is struggling to really find its own voice.
Look, I think the EU would be struggling more if it weren't for Russia's full-scale invasion of Ukraine. In a way, the possibilities to divide Europe away from the US in the contest with China would have been more possible if Putin hadn't invaded Ukraine. China is then forced to make a call one way or the other. It might be an axis of convenience, but ultimately for China, Russia losing is the worst outcome. They don't need Russia to win, but if Russia lost, China would be left alone against a United States and a resurgent NATO and a resurgent West. So by linking those two sides together, the Europeans have realized we now rely even more on America for our long-term security. We're facing a belligerent Russia. So even though they're skeptical about some of the U.S. steps to try to sort of extract China from their economy. We're much more dependent on China than the Americans are. We've run trade surpluses over time. Certainly Germany has with China. It's a different type of contest. I think for them, for Europeans right now, it is a matter of trying to work out, will Biden win or will Trump win? Because if Trump wins, then suddenly that reliance on the United States becomes much more risky.
But, Robert, so you have a whole chapter on this renewed transatlantic partnership.
Yep.
Can the U.S. actually sustain it? I mean, we always talk about U.S. exceptionalism.
Yep.
They're fighting two wars. They're very divided internally. I know they have great innovation, but where is the U.S. right now? Can they afford all of this?
The U.S. can afford all of this in terms of money. They can certainly afford $40, $50 billion, $60 billion over 3 years to support Ukraine. If you look in the total map of spending and expense, especially as the bulk of that money is spent inside the United States. The question is, can they afford it psychologically? Just as America was trying to think that we need to focus more on ourselves, that was the source of the first Trump victory, Biden wanted to say, no, I've got a better plan for rebuilding America. Instead, American voters are seeing the United States pulled into three conflicts in different ways simultaneously. So my worry isn't about the money, it's about the political support. And I think this is what Europeans realize as well. So what they're trying to do is saying, look, we will put more skin in the game. We will spend more on defense. We'll buy more of your liquefied natural gas. We'll do the things that Trump 1 asked us to do, so you'll stick with us.
But is this really the end of multilateralism? And where does it live? For example, the UK, we have an election this year. It's a small, open economy.
I think it's multilateralism, if we're talking about a UN system, is on hold for the next 20, 30 years. China, in a way, sees multilateralism as a useful prop, but they're investing their effort in the BRICS, in spaces where they can have a dominant voice. And they think they're in competition with the G7. And that's the way they're seeing the world. And the UN, in a way, is a bit of a side picture on this at the moment. For a country like the UK, look, it was almost be more difficult for the UK if the world was stable, because that would expose the UK's vulnerabilities. But as a permanent member of the UN Security Council, a member of the G20, a member of the G7, actually it has a bit of a voice in this conflict. In a more dangerous world, in a way, some of the UK's strengths stand out a bit more strongly. Forces the EU to maybe concede some things to it might not otherwise. So I think the UK can navigate this.
But, I mean, again, the world is very complex, and it feels like there's more bad news than encouraging news. So how does a country thrive in this kind of environment?
The first thing you've got to do is make sure, if you're in a democracy, a country. My book, in the end, is targeted in the last section on what liberal democracies need to do.
Should do. Yeah.
One of the key elements of this is to make sure that we are strong in ourselves. And that means being strong economically, strong politically, and in the end, trying to knit together this sort of G7, which is now including as well Australia and South Korea, into a grouping that can survive the turbulence of the next few years. Obviously, right now, in 2024, a Donald Trump might look at the G7 and say, hold on a minute, who do I have the biggest trade deficit with? Yeah. The US has a trade deficit with the G7, at $340 billion, that is bigger than the deficit it has with China, at $280 billion, roughly. So you could see him saying, I don't care about this G7. What's all this thing about? So I think at the moment, what we need to do as Europeans is focus on ourselves, build a little bit more internally, invest more in our economies, invest more in our defence, and see where we take it from there.
I mean, every time I ask this question to a head of state, they always roll their eyes. But is there any way of Trump-proofing some of our economies in case he gets to the White House in November?
The Trump-proofing is partly about defence, but also economically. I think it is possible to Trump-proof the economy. It means being able to make sure that you've got alternatives in your global markets. I think the biggest challenge for Europe going forward is going to be thinking about how it integrates Africa. And one of the main things I talk about in this book is that although it's a new Cold War, it's not like the last one, because most of the rest of the world doesn't care about it at all. They are triangulating between the two big sides. And there's a huge opportunity for Europe right now to look, and America, by the way, to look at the global south countries, to look at Latin America, to look at Africa. You notice the Brazilians are suddenly being flooded with cheap Chinese exports. They're not happy with that very transactional approach. So I think we need to try and win the new Cold War in the global south.
Robin, whilst reading this book, is there something that surprised you? I mean, I know you look at this, day in, day out, and have been in foreign affairs for the last 15, 16 years. But through your research, what's the thing you're most optimistic about?
You said there's something that surprised me, and then it's the thing I'm most optimistic about. The thing that surprised...
They're not the same?
Unfortunately not. The thing that, I don't know about surprising me, but really came to my realization is this sense that we're in an early stage of the new Cold War and we do not have rules for nuclear weapons. The Chinese are investing in their nuclear weapons. They'll be up around 1,000, probably, certainly 800 nuclear warheads soon. They want to get probably to match the US and China at 1,500. At that moment, if you're in the US, you're thinking, hold on, it's not China with 1,500 and the US with 1,500. It's 3,000 together. That's something that dominates us. So I talk a lot about arms control. We need to get that going again. I think on the positive side, I've been amazed at the extent to which, for the first time, we're seeing a knitting together of America's Pacific allies and its transatlantic allies. You've got Japan, South Korea, Australia sort of being integrated in a way in with the NATO, bigger EU, UK, Norway. And that's a very powerful combination if you can knit it together over the coming years. This is where the Trump presidency is a risk. But I think use 2024, you've got the 50th anniversary of the G7 coming up. Use this year to really invest and in a way, Trump-proof that Trans-Pacific, Transatlantic alliance.
Robin, thank you so much, as always, for joining us. Robin Niblett there, the former director of Chatham House and, of course, author of a new book, The New Cold War. Now, coming up, today marks a year since UBS took over its Swiss rival Credit Suisse. We'll bring you a deep dive on just how advantageous the deal has been for the bank next. This is Bloomberg.
Who would have expected UBS shares to have soared since the bank took over its ailing Swiss rival Credit Suisse 1 year ago? Yet that's exactly what's happened, with the stock hitting a 16-year high in early March. Behind this, confidence in Chief Executive Sergio Ermotti's turnaround of the Swiss lender and integration of the two banks.
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans.
Ermotti's goal is simple: to make UBS the undisputed global wealth champion and take on Wall Street rivals where they have the home advantage. In the US, UBS chief hopes to leverage former Credit Suisse clients in the US and manage their wealth, including those still building their fortunes. But catching up with these American financial giants will take time and come at a cost.
More than 50% of our cost is headcount, and there are duplications, but we try to do it over time.
European banks, including Deutsche Bank and HSBC, and even UBS, have previously tried to crack the US market and had to pull back. But this time, UBS aims to be the one left standing at the end of this round.
Well, Bloomberg's Samuel Etienne there reporting on the outlook for UBS 1 year after the lender took over troubled rival Credit Suisse. Now, we're joined by Bloomberg's Charlie Well here in the studio. I mean, I remember like it was yesterday. I can't believe it's been a year already. So the 19th of March, 2023, we were in Bern for that press conference. We knew something was cobbled together. They wiped out the AT1s, but it feels like AT1 is back, and actually UBS has done very well out of this deal.
So much better than expected. I mean, when they announced that deal, it was so hastily put together. I remember immediately after the share price fell as much as 16%. But look, fast forward to where we are now, the share price for UBS is up 60%. They've got a market cap of $100 billion. And so this is actually going a lot better than expected. And really what UBS got here was a bigger investment bank, but they also got this potential with wealth management. And that is so attractive to them by acquiring Credit Suisse. The funds that they're for clients that are managed by their wealth unit are up a fifth to $3.4 trillion. So that is a huge opportunity for them.
I mean, I think at the time they were worried, which is why then I think in August they kind of said, look, we don't need that much government backing, is that they were worried about what they'd find, especially in the investment bank of Credit Suisse. So I guess some of the unwinding is maybe a little bit less messy than it could have been unless this comes further down the line.
Yeah, they just didn't have time to do a lot of that diligence that you would expect. And I think that's why there was some of this government backing. And look, Sergio Ermotti seems to be doing an incredible job here, right? He's done this before. He was CEO from 2011 to 2020. He was brought back to do this. He's been something of a stabilizing force during that period from 2011 to 2020. He kind of did that pivot away from investment banking at UBS into wealth management. And that seems like something that they really want to do here, right? And their focus is on the United States.
Yeah, and it has to be the ultra-rich, right, if they're going to close that gap with Morgan Stanley.
Absolutely. I mean, Ermotti has this stat that he loves to cite, which is that there are 36,000 people in the United States who have liquid net worth of over $100 million. And so we hear a lot about how the U.S. still is the center of kind of global money, and that really is the case here. But they face a lot of competition, right? I think Morgan Stanley is what they really got their eyes set on. And I think the goal is to try to kind of use their increased footing in investment banking that they have through Credit Suisse, through that acquisition, to try to funnel clients into their wealth management unit. But they have a lot of competition. As I said, UBS, they've got about 6,000 financial advisors in the United States. Morgan Stanley, they've got 16,000.
But so I guess the concern is that they lost clients that were banking with Credit Suisse. And so how do you get those clients back, especially in Switzerland?
Yeah, I mean, you've got to rebuild confidence, right? And that's something that, we're seeing, with concerns about the larger Swiss banking industry. And I think regulators are talking about, the need potentially for this bank to have more capital now that they've grown so much. But it's kind of rebuilding trust, but also kind of, using their increased tools that they have with this larger investment bank to try to funnel people in. I mean, in the United States, they tried to do this before in some senses with their acquisition or the attempted acquisition of Wealthfront, which is a robo-advisor. And so it's kind of a new take and trying to kind of, help create wealth through investment banking clients and then bring them into that wealth unit.
Okay, let's also bring in Tom Metcalf, who oversees all of our, of course, banking coverage across the MEA. Tom, I don't know whether there's going to be more introspection about what exactly happened with Credit Suisse and whether, something like this needs to be avoided. Like, what's the feeling in Switzerland?
Yeah, it's interesting to be here a year on. I remember sort of a year ago, it was such an intense period. And, walking through Zurich today, just any old day, right? I think there is still such a huge moment for finance, but also for Switzerland specifically, that this is still rumbling on. Just today we had the Swiss National Bank saying, hey, we should think about giving more regulatory sort of capital requirements to something like UBS, given its size. From my perspective as I sit here, it's one of those stories that's going to run around not for months but for years, and frankly, finance has pretty much changed forever.
So, Tom, again, 1 year on, are you surprised at how well they've done out of it? I mean, this is difficult because they're pitching for new business, they're pitching for new clients, so they're flying the airplane, whilst at the same time they have to integrate, let people go. So this is not an easy job.
No, absolutely, and that's what the executives have been saying is actually the hard part starts now, in terms of, yes, they need to really start to drill down into costs. Probably many more job cuts to come. I think it was once, I think back at the time, described as potentially the deal of the century, with lots of caveats because it's so hard to integrate massive institutions like this. But I think if you're looking at for a report card of the first year, UBS are probably going to be pretty happy. Look at that share price, right? It's now north of $100 billion. On the day after the deal, it was something around 60 billion. So anyone's going to take that kind of uplift. And yeah, the big question is, it's all about the execution. That's what all the analysts are saying is, if they can execute, this will indeed be deal of the century, but there's a whole lot of sort of minefields and sort of trips up ahead.
So, Tom, I mean, again, the questions that we have, are they around execution? If you're also a Swiss citizen, you used to be able to choose a mortgage between two banks. You're only now left with one bank that's probably too big to fail.
Yeah, I mean, that is the interesting thing, right? As part of the deal, kind of all those competition concerns were waved through. And, for me, that's the most interesting thing, because those concerns are still absolutely floating around out here. And it's sort of like, is there really any recourse at this point? Because, quite rightly, UBS might point, hold on a minute, we had sort of this was all passed through, this was all legal. And they are very, very keen, in the case of Swiss banking, to keep the Swiss unit. And I think the sense is they will do, their absolute utmost to keep it within the group. So that is, probably more of a political thing than perhaps a corporate concern right now.
Tom, overall, I know we were talking at the time last year, and I remember actually being on text messages with you, that Sunday. It's kind of tattooed to our brain because it felt like it was such a big deal, and it was cobbled together. And frankly, just 4 days before, no one was really expecting this huge takeover. Tom, at the time we were talking about whether it would kind of push more consolidation, more M&A in the industry. Do you think that's a real possibility with the Capital Markets Union, or is this just, specific to UBS and Credit Suisse?
So if we're talking about these big cross-border deals, everything all the top bank executives say is around that, sort of Capital Markets Union is, for that to happen in Europe, they need the regulators to sort of smooth the way. And that's obviously them talking their own book. So, my sense is those mega deals are probably not going to happen without some changes on the regulatory front. But, every day we're hearing, chatter about, might this firm do something with this firm? There's definitely kind of those animal spirits stirring. It just might be more on, domestic deals or bolt-on acquisitions. But I think, in terms of, what's coming down the pipe in 2024, I suspect it'll be the year of mini M&A maybe in banking.
I like that, mini M&A. And Charlie, but it's still, very difficult. I know we talk in wealth management whether UBS can really rival Morgan Stanley, but it's very difficult with, an investment bank that's just nowhere near some of the Wall Street titans for a European bank to take on Wall Street. I
mean, that's exactly right. And look, other people are trying to do this as well. There was a great interview on Bloomberg TV yesterday with the CEO of Barclays, CS Venkatakrishnan, talking about how Barclays wanted to try to, kind of establish or kind of build on some of its footing that it has in the United States as well. And so this is really challenging, and it's something that a lot of people want. What's interesting yesterday that Venkat, as he's known, spoke about was kind of Barclays as this almost deglobalization play, as how for, investment banking, sometimes it can be good not to have everything concentrated in the United States. He was certainly pitching London. UBS could be talking that as well in the future as we see this kind of deglobalization theme, having some of that counterparty risk in another country, that could bode well for them.
All right, Charlie and Tom, thank you so much. Charlie Wells and Tom Metcalf joining us today on banking. Much more to come. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Barclays is seeking to expand its relationships with sovereign wealth funds and private equity giants as it broadens its footprint in advisory and equity underwriting. Well, Barclays chief executive spoke exclusively to Bloomberg.
Lending is an important part of what we do. We are a very big player in the fixed income markets, in the debt capital markets, as well as fixed income trading. So lending is a part of what we do, but we're just trying to broaden it into more advisory and more equity-related revenues.
How much is this sort of a new model of banking that's basically taking all of Wall Street and a lot of the global banks too, which is trying to cater to the whole client rather than, say, go after specific deals and be focused on, for example, being at the top of a league table?
Yeah. I think it's an important part of the shift that's happening. And it's happening because previously, in the investment banking side, we were working with corporations. And since then, we still work with corporations in a very big way. But in addition to that, you've got the financial sponsors and the sovereign wealth funds. So the growth of concentrated pools of capital makes it important to have that full relationship with those players in the market.
This week, we do get a Bank of England decision. Is it beneficial if rates stay higher for longer, or do you want them to come down to support the economic growth and maybe some of the engine that John was talking about?
So ultimately, that's a decision they have to make. It's very important to balance.
Sure. But,
yeah.
you know.
You've got to make a call.
I actually think a little prudence and waiting a little is not a bad thing.
You think there is an option there to wait a little longer then? Why do you think so? Why is the bigger risk maybe to cut too soon and not to hold too long?
Well, I think that the economy is stabilizing. Employment is still robust. Inflation is coming down. So I think on the balance, it might be more prudent to wait a little longer. Now, our house view and that of many others is for more rate cuts over this year.
Would the same apply to the US? The same characterization of the situation?
I think so, yeah.
Well, but just, would that be good for you? Are high rates good for banks or are they bad for banks? This has been a perennial question.
Stable rates are good for banks.
Well, that was the Barclays chief executive officer speaking exclusively on Bloomberg. Now, to some of the other stories making news, and China's top securities regulator has accused developer Evergrande of falsely inflating revenue by more than $78 billion in the 2 years leading up to its failure. Well, Evergrande is a defaulted developer at the heart of China's real estate crisis. Chinese regulators have laid much of the blame on Hui Ka-yan, the company's founder and former chairman. No criminal charges against Hui have been made public, and his whereabouts are not known. Now, Bloomberg has learned that Donald Trump has ruled out Vivek Ramaswamy as his running mate for president. Sources say the Republican nominee is now eyeing the entrepreneur for a cabinet job. Trump personally told Ramaswamy he will not be his vice presidential pick, but is considering him for posts, including Homeland Securities. Of course, the picture across the board for markets, a lot of focus on everything that has to do with the Bank of Japan. We look at yen, treasuries. We now move on to the Fed next, and then BOE on Thursday. Surveillance next.